Hello, everyone. I'm Phil Mang. I head up liquidity, markets, and treasury at Stellar. My background's in derivatives trading and mostly market-related activities, and anything that kind of touches liquidity or markets kind of goes through me. I'd like to introduce our two panelists here. We have Marcus Luna Paulson. Did I go the wrong way? Marcus Paulson Luna from Script 3, and Kazim, I'm not going to try to pronounce his last name, from ARF. So I'll get started. Generally, when we think about liquidity, we've always talked about market liquidity, meaning the ability to exchange from asset to asset. Right? Like a lot of times we talk about liquidity on the DEX when people want to go from asset A to asset B, and in the framework of Stellar for a cross-border payment, it would be a stablecoin asset to another stablecoin asset. There need to be liquidity providers so that this liquidity and conversion is efficient and cheap. But one of the things that I kind of want to zoom out a little bit is, where does this liquidity come from? Generally, it comes from liquidity providers who are professionals, and they provide liquidity because it's profitable. They can capture spread when they do these transactions. One of the things that we did that improved, or in an attempt to improve liquidity, was build AMM functionality into the protocol. Because with AMM functionality, you don't necessarily need professional market makers to provide that liquidity. Anybody, in theory, could deposit funds into a liquidity pool, earn some interest, and that market is made more efficient and available for these cross-border payments or other activities. But like when you zoom out, you think about, well, what is needed for this liquidity? And the main thing I kind of want to talk about is capital availability, because this liquidity doesn't exist without capital. So when you think about, well, where does capital come from? That's kind of the main question for liquidity provision. So my background's in equities. The reason that equities markets are pretty functional is because there's very efficient and good lending and borrowing. So like when you're, if you know it or not, when you're trading equities, professional market makers are buying or borrowing stock to enable that liquidity. So I want to open it up to these two gentlemen and talk about kind of capital availability and kind of like how they see liquidity, the availability of capital as a challenge, and kind of the things that they're doing to solve.
Sure, yeah. I guess I can start off by talking about what I'm doing and how that affects capital availability and liquidity on Stellar. I build decentralized finance protocols, and right now we're working on a money market on Stellar. For those of you that aren't familiar, money markets are just venues for lenders to lend money and borrowers to borrow money from those lenders, right? So where capital availability and liquidity fits into that is like the base requirement for a blockchain to have an actual liquid market to any extent is to have capital on the blockchain, right? And then also have a functionality for trustlessly moving that capital from passive participants in the blockchain to active participants in the blockchain. So money markets fit in really well there because they give a place for passive capital to be stored on the blockchain and actually generate interest. The blockchain starts to look a lot like a bank, where it actually starts to make sense to take your dollars and store them in USDC in that lending market or whatever other asset you have. And now instead of Celsius storing your assets and doing whatever they want with it, those assets are now stored in a DeFi protocol on the blockchain, where market makers or any other participant can go and borrow from to clear remittances, to make loans to, I guess, any financier who needs capital, or to be used in trading, pretty much whatever you want. So it's all about moving capital around.
I'm Kazım. I'm one of the co-founders of ARV, and the problem of liquidity shows us in a different form, a bit, basically. So if you look at real-time payments or cross-border payments, you see that there's a $4 trillion locked inside the financial system in order to facilitate the payments, cross-border payments. Basically, we have a correspondent banking infrastructure that has 1.3 million contracts, and the inefficiencies are compensated by these $4 trillion locked. So cross-border payments, remittances is a very capital-heavy business, and all these companies that are in that business actually needs liquidity. They need financing in order to have these pre-funding in their partners, in their respective jurisdictions. So we have a liquidity problem that shows itself as pre-funding. And at ARF, basically, our first approach was to improve the problem was, instead of having multiple treasuries in multiple jurisdictions, let's have digital asset settlements, like using USDC for settlements between financial institutions and have a single treasury at hand. So inefficiencies at these multiple endpoints are removed. And once we did that, we see the compliance problems and everything that is attached within. So right now at ARF, we are introducing this credit line product, again, this providing liquidity and capital in order to remove friction and also do settlements with these digital assets. In a sense, right now we are looking liquidity and provide credit in USDC, and the sources that we are seeing these institutions. And the DeFi protocols, as emerged DeFi protocols, especially, for example, you guys are building a DeFi protocol that we are able to leverage. We see Stellar a perfect protocol for it because we built our cross-border settlements infrastructure on top of your open protocols like SEP31, etc. So having this liquidity that can be acquired natively on Stellar will provide a big benefits for us too.
Yeah. So like, I guess to tie what we do together, they're the demand side for the liquidity, and we make supplying that liquidity extremely easy. We can set up a custom money market for them where they provide their customers with lines of credit that we recognize through an Oracle solution, and then anyone on the Stellar network can choose to deposit capital in that money market, so it can be lent out to their customers. So it creates a place for that capital to sit idle and earn like 20% or whatever their customers are willing to pay, but there's no actual, like, really, the trust assumptions are minimized there because we're just relying on them to issue lines of credit. They don't have to actually go to any normal financiers. It's just Stellar users or institutions using Stellar that can provide that financing.
Yeah, I kind of want to go back to what Kazim was saying, because like the amount of time it takes for a normal cross-border settlement. Can you talk about like how like the costs and the inefficiencies of using the traditional system right now, and what this credit line will kind of break down like for a barrier?
For sure. If we just zoom in and see that there are two financial institutions in different jurisdictions, in different geographical regions. The first one is collecting money from the fiat money, possibly, from the local channels, either banks or cash pickups. So they have this cash already, and they are using their partners, the pre-funding account on their partners, to do the payouts. There is a fixed conversion involved. And obviously, the pre-funding, the treasury should be topped up by using correspondent banking system and SWIFT. And if you are talking about remote regions, the SWIFT can take some time. So basically, you have to have certain amount of treasury. If your volume is high, you have high pre-funding requirements and high dependency and high latency because of the correspondent banking system.
Which basically means you actually need to have more capital to kind of run your business.
Unfortunately, yes. This is
So
as you grow, you need more.
So with that, like this credit line product allows companies to not have to have that pre-funding. They can actually just borrow money to kind of have that pre-funding in place.
Exactly, exactly. And if they are dependent because of the regulation, even the local, if they have to do SWIFTs because they are unable to do on-chain transactions, etc., this credit line will cover the amount of time, so they are able to at least be in business and operate without the required pre-funding.
So like in a certain way, like right now you guys are running more of a centralized kind of like borrowing and lending. And then Marcus over here is kind of doing it in more of a decentralized way with kind of the trust minimized issues.
Approach, yeah.
Yeah.
Yeah, exactly.
So, oh,
Yeah, and the good benefit is, for example, we see a lot of lending protocols on different blockchains, right? So in the end, we see there is high correlation about the prices, cryptocurrency prices. But for example, in our model, because we are lending the money to specific institutions, to money service businesses, with specific rates, very transparently, on-chain payments and lendings are happening on-chain. So basically, we are providing a real world asset-based value, so we can brought real world economy into the blockchain, into these DeFi platforms, which provides a great benefit because it doesn't, it is not fluctuating, at least, more stable.
yeah, I love that. So like for those of you guys familiar with, crypto lending in the past 12 months, a lot of it, I'm not going to make up a number, but like a lot of it, more than 50% was driven by leverage or trading activities, right? Mm-hmm. And most of the borrowers are trading firms that will borrow to either put on bigger size or to trade different kinds of trading strategies. And obviously over the past 6 months, we've seen kind of what's happened to trading markets or like crypto markets, and the lending businesses have kind of become unviable, right? And when you look at DeFi, you see a lot of these DeFi protocols that have been creating unsustainable incentives where it's like, okay, like lenders, like, if I want to deposit funds into a DeFi protocol to earn 10, 20, 50, 500% yields, okay, like I think they did exist, but like obviously those yields are not sustainable. They were being subsidized with different token mechanics, but over time, and it didn't take long for that to kind of shake out, they're proven not to be viable. So like what I love with what both these guys are doing is the real world use, right? So like money, the capital that is deposited with Script3, their Yield Blocks product, that gets used by ARF is actually being distributed by real people in the real world that aren't just punting on NFTs or other crypto.
No, exactly. It's about creating capital usefulness with the capital that we can generate or source on chain. And the one really positive thing about the whole speculative mania and like crazy token incentives that we saw over the last 12 months was blockchains actually got really good at sourcing capital and getting it on chain because everybody wanted their money on chain because you could get 20% in Anchor protocol, right? So now that we've gotten all of these good on-ramps, we can start to figure out how to actually place that capital back in the real world and use blockchain as like a distributor and a trust minimized middleman, so to speak, which is what we've been trying to do for ages, right? That's been the whole point. It's just now I guess we're finally trying to get there.
Yes, and with a combination, this complementary nature of the solution, we are going to provide a lot of transparency. Because if you look at the current lending platforms, protocols, for example, we have Maple, right, very centralized, and we have models like Goldfinch. So in the end, they are giving pools money to SME lenders, but after that, the transparency lacks. So with companies or with mechanics like ARF, we are able to show the lending and repayments happening on-chain even to the lenders. So the institutions that are withdrawing money from the pools are actually using it, showing it in short term on-chain, so which brings a wider visibility, which hasn't happened before. And this visibility is tied to real-world asset usage. So it's in nature, I think it's very unique in that sense.
So like, I mean, I've seen some kind of more consumer facing products that like, because things are on chain, you could actually see you could make better kind of credit kind of scoring or credit predictability, right? Like if I use my credit card and American Express sees that normally I spend between this amount and this amount, and something goes like 1 month, like there's odd transaction, you can kind of determine fraud more easily. But like for a business, if you see erratic kind of payment, like you can kind of get a better understanding and visibility to potential activity that maybe this isn't part of their normal business, and then it can raise red flags earlier. Do you see that as kind of like, how like, keeping stuff on chain and keeping credit on chain will improve the ability for companies to underwrite credit?
Yes, obviously, very important. And there is one other very big aspect of having all these things on chain and having to build the capability to build a credit score on chain is, for example, if you are an MSP, money service business, you have your creditors in local jurisdictions. So Singapore lenders know you as a Singaporean money service business, but nobody in the other regions of the world knows you. So if you are building ties, building business relationships, cross-border payments, etc., it's going to be a tough problem. But once with USDC credit lines, credit scoring, credit scores on-chain, then you have the ability to actually claim and show your performance, right? And it's universal. It's USDC-based, it's transparent. You can build a lot of things on top of this.
That's a... I love how you can start to get on-chain credit scoring right now, but I don't think it's even that essential, which is the best part of all this. Like you can have the on-chain credit scoring, and that will allow some people to have more trust in various lenders. But when you do things like create isolated lending pools, which is what we do, you can have it almost ends up looking like the Stellar Consensus Protocol, where you have quorums of people that trust certain individuals, but maybe other lenders don't trust them, but maybe they trust those lenders, right? The lenders that trust that other lender, right? So you can have one pool that's lending to let's call it the ARF pool. You can have an ARF pool where it's all the different ARF borrowers that were accredited by ARF and sourced by ARF. And some people are comfortable with those borrowers, but maybe other people aren't quite that comfortable, so they want to stay in a safer pool that's maybe 100% over-collateralized by crypto. And then there will be actors that will actually arbitrage the rate difference there because they're comfortable with ARF. So you can kind of still maintain a high level of capital efficiency despite the different trust requirements of the different actors in the space.
Perfectly summarized. And even if you are talking about this, you can see the variety of products, offerings, and capabilities that can be built on top of all this. So, so in terms of expandability, it really promises a lot, all these mechanics.
So I kind of want to circle back to kind of market liquidity, right? So like, I mean, obviously at Stellar, we're very focused on efficient cross-border. Like at some point, like, like FX and FX convertibility and ease is something that I think a lot about. So when I kind of started the conversation where it's like, hey, markets need to be deep, they need to be liquid, and where does this capital come from? If there's a lot of payment volume between, let's call it USDC and a euro asset, right? There's going to be demand for that, those funds. And if there's demand for those funds, that means there's a willingness to pay for that borrow. So like, I could see if those markets need to be deepened and there's millions or hundreds of, let's go to millions and tens of millions first, and then hundreds of millions to start. That could easily come from your platform, right?
Yeah.
Like, can you talk about like what a user experience might look like if I have capital, and then what it might look like if I need capital?
Yeah. So just to totally understand the question, who are the actors involved in the needing capital? Is that just anybody that needs capital, or is that it was specific with the payment use case?
With the payment use case.
Okay, yeah. So I guess in the have capital aspect, that one's pretty straightforward. That's like anybody sitting in this room that has USDC or euro that they don't want or don't need at the moment. Yeah.
That's not say don't want.
No, that's not say don't want. Most people want money. So they don't need it at the moment. It's just like sitting in their wallet or whatever. They go deposit it into a lending market. And then it's periodically borrowed by whatever borrowers are using that market. So those are the parties that want capital. So that could be, in the payment example, let's say there's someone that needs to clear a euro payment. They need to settle it, but they don't necessarily have or want euros on their book. They can go borrow euros from the protocol against their USDC or something and not take on any price exposure, but still manage to clear that payment efficiently. On the other side of things, they could be like doing cross-border remittances or something, and maybe they just don't want to keep capital on their book at all. Like they have low capital in their book, but they still need to clear all these payments. So then they can go and borrow under collateralized from us if there's someone willing to write them a line of credit and handle their payments that way, all while paying interest to the passive actor that's providing that liquidity. And then you have the third aspect where there's someone that's literally just making a market on Euro and USDC, and let's say they have the algorithm to do it, or they're using liquidity pool and they understand how to efficiently do that, but they don't necessarily have the actual capital to go and make a liquid market. They could either participate in, maybe there's a protocol that's based around making lines of credit for market makers, and they get credit that way, or they could do something with liquidity pools where they create USDC, Euro liquidity pools, and then use those pools as collateral to borrow more of those assets and package more of them into the liquidity pool, effectively like moving assets that are just passive in the lending protocol into liquidity pools that are actively making the market more efficient.
Yeah, I mean, if I'm a market maker and I can generate 20% by my market making activity, and I can borrow, and I don't have the funds, or I want to scale up, I could borrow at 12% or whatever, and kind of capture that net margin, and then the depositor, like the folks in this room, can earn 12% on capital that isn't speculative, but like it's. I don't know if legal's in this room, but people can earn on their idle assets that's being put to use in some way.
Yeah, exactly. That's the whole point. Right?
I kind of want to open up the floor to some questions, but like before I do, one last thing I kind of just love seeing here is like what DeFi really showed. Like, I mean, I think a lot of people talk about the past couple of years and DeFi kind of failed, or it didn't work. I think for me, and maybe you guys can agree or disagree, like what really DeFi really showed us was there is so much capital out there, and I think you were kind of getting to this, and of course, like I think there's a ton of need for capital for just a lot of use cases. And the ability that DeFi was able to bridge these things, despite it wasn't really, it kind of didn't work. Like it did show that there's a lot of capital out there, there's a lot of need out there, and DeFi is able to kind of connect those two. Mm-hmm. Do you see that kind of still being the case? Do you guys think that is kind of not so viable anymore? Like, what are your thoughts here?
That's like the base. I think saying DeFi failed is just the most ridiculous statement, because it implies that DeFi's done, and like DeFi's in its.
We're just getting
years.
started.
Yeah, it started like a year and a half ago or something. Like, no, it's not done. What do you mean? So no, I think it's really shown to be really highly efficient at connecting various parties. I think AMMs are a beautiful example of that, because despite being pretty capital inefficient, AMMs were an excellent way to connect people with idle capital on early blockchains. So I mean, this isn't even that early. Like AMMs came out like 2 years ago. But they connected all these people that were just holding dollars in ETH with people that wanted to trade dollars in ETH, and actually managed to make a very liquid on-chain market without needing a complex order matching engine, without needing a huge legal team, without needing to be a centralized exchange. They still managed to create that with just some math and some code in the blockchain. So yeah, I guess it's all about, like, it does a good job at creating access to financial services that is, like, yeah, it's indiscriminate, and anybody who has capital, which is a lot of people, and needs it, it connects the two, you know?
Yeah, I think we're just getting started, and especially in our case, we are seeing it as the necessary fundamental infrastructure, building blocks to realize like real-world asset tokenization, realize our business models, launching specific protocols that serves certain institutions or certain business models. So we just see the basic building blocks, and everybody is starting to use that, and we are going to see a variety of tools, platforms that serve specific needs. So it's very exciting, I see.
Mm-hmm. No, I'm really excited. I think like the next, or one of the next things that we're going to start see being built is probably more liquid FX derivative markets, because from those markets are actually fairly inefficient in most parts of the world, and they hold back a lot of activity in developing countries because you literally can't hedge currency risk if you're running an international business. But with a DeFi platform that settles FX swaps or whatever FX derivative you want, that's accessible to anybody, you could open up a factory in Indonesia that does business with the US and get access to highly liquid derivative markets without actually needing to be an international entity, and we manage to hedge your currency risk that way. And it's a hugely underexplored area that DeFi is so incredibly well suited for that like hasn't even started being touched yet.
Yeah, we're actually working with a company that is building a DeFi FX stablecoin marketplace. So
yeah, that's sweet.
Yeah.
It's hugely valuable. I mean, it's probably gonna like just improve economic development and equality around the world. Like,
No, I'm on the same page there. So we have 5 minutes left. I'll open it up to questions.
Hello. I had a question about like what kind of liquidities, using your, for example, platforms you can actually add. Because just to give an example, I was doing some analysis on Stellar Terms, so the DEX at the moment, and the largest volume per 24 hours is really like USDC XLM, about 450K in a 24-hour period. But outside of that, you're falling below 6K. And so, even just to do general stablecoin business, I mean, any kind of transaction, I mean, we're not even talking millions here. We're like, if you could get to even 10, 20, 30K, that's still a lot more volume than what, we have going on right now. I think the lowest I have is like $940.
Yeah, so I mean, sorry.
Yeah, so it's just more like, how can we bring that into the millions? Because we're quite far away from that.
So yeah, I think from the Stellar side, like there's two sides of this, right? One is the supply side, where it's like, all right, well, where is the liquidity coming from? Where is the capital coming from? And then there's the demand side, right? Like, I mean, you're talking about XLM and USDC. Like, I still internally believe that it starts with kind of assets. Like, I mean, I personally am not as concerned about like trading activity with assets that aren't payment related. But like, if we had, and this is something that we're working towards, more high quality issuers. So like, imagine we have USDC, Euro, Yen, and like, some South American and Latin American countries that there are payment flows. So now, like, we're working on these companies that have these flows going to or from these locations, right? When there's demand for that, it's like, okay, right now there isn't that much supply, but when there's demand, there's going to be again a higher willingness to pay. There will be more, like, I'm a money business. Like, I mean, ARF would be doing this in a centralized way, but like, I don't have the capital. I don't want to pay the capital to top up, right? Like, I can borrow funds and I can send this payment, and I have a willingness to pay for that capital for 1 day, 3 days, 5 days, right? At some point, and this is kind of like maybe like an idealistic way, but like we've seen this in other ecosystems where when there's that demand and there's an easy way to deposit, which is what these guys are building over here, if you put 20% for someone to deposit, like, a Latin American asset for this liquidity, like for the initial amount of liquidity that's required, people will do it. Like, and this is kind of what we were just saying, like the ability to attract capital. I think is high, and there's less barriers to that. So like when you have that demand, like I think supply will come. I don't think it's necessarily sequential that way, but it is, like locks, like step by, like, there's some demand. All right, there's going to be supply, demand, supply, and it kind of like builds up. That's how I kind of see liquidity kind of growing.
Yeah.
The next largest value is Brazilian, the BRL.
Yeah.
And USDC is only 6K every 24 hours.
Yes. Yeah.
Which
Sorry, go ahead.
it's low. And so that's also like, because we are a Euro C stable coin, and that's something we've been looking at is the overall liquidity of the market. And it's actually quite challenging, we've found so far. So.
Yeah.
But as an issuer, because this is something I feel strongly about. As an issuer, I actually think, because look at Tether, look at Circle. Like they think of their asset as a product, so they're getting their asset out there. So there's demand for this asset, right? So like some of the issuers that we've worked with, they're more either supply focused or they haven't been kind of like, who's going to want my asset? Who's going to want like Ray I, and what are they using it for, right? Like there has been less kind of push on that, like from like, my seat. So like, what I've been kind of like, having conversations with some of these folks is it's like, you need to have like, a really good use case and then like, kind of a product focus on your asset to like kind of drive that demand.
Exactly, and I think that's why we step in. So, for example, we are serving financial institutions and the settlements between them, and we are using USDC for their in-between settlements. We are not converting anything. We are not looking liquidity for other stablecoins. Basically, we are utilizing USDC directly. In our case, we are able to utilize 5x of our facility. For example, if we are pushing 10 million to the market, we are able to provide liquidity for $50 million per month processing. Basically, this is the angle that we approach. So these liquidity numbers doesn't make sense. Sure, of course.
Yeah.
If you look at USDC, 1% of their total capital is just on Stellar. So the real issue is Stellar's volume of liquidity for these stable coins. If we actually maybe take into other networks, that's a different topic. But specifically for Stellar, if someone's starting out on Stellar, it's a very interesting start that actually we have, and like we've been talking to some of the other stable coins, and liquidity is a very big challenge if you're only starting out on Stellar. And so this is like, how can we, maybe work together that, on Stellar, we can get that higher going, and so these are just things where it's something we've found to be quite interesting and also quite challenging.
Yeah, and just to tie, I think what we set up here together and what we started this whole conversation with, I'm actually shocked that there's so much volume with the XLM USDC pair on the DEX, because from my point of view, there's very, very little reason to have active capital on Stellar right now. I think that's why Stellar needs a DeFi ecosystem and needs other ways for capital to be. Capital needs a reason to be on Stellar. We just need to attract capital. The way you do that is by having useful financial applications, which is what DeFi is. That's why Ethereum is by far the richest blockchain there is in terms of capital availability, because they have a super rich, very deep DeFi ecosystem. Once you get more primitive applications, more DEXs that are interesting to trade on, more money markets that have real world applications or can just lend to market makers, you start to see a lot more volume grow because there's capital there in the first place to utilize the DEX and take the other end of trades and that kind of stuff. So it's, like Phil was saying, there just needs to be a reason, demand for capital on chain, which there isn't so much right now.
If you're a Euro issuer, I definitely want to talk to you after the session. I think that's. Do we have time? What's that? Do we? Oh, all right. Sure.
Sure. It's just more of a follow-up on the stable coins. And it's more on what you were saying, Phil. It's really the demand for the stablecoin that dictates the volumes. So that's what we've noticed, regardless of what blockchain you're on. So whether it be, and I guess your point was more on the USDC, how many people are the volume on the USDC, but it'll always take time, just like USDC on many other platforms. So many other platforms are very low volumes on USDC. However, when you're doing other stable coins, whether it be Euro or whether it be Brazilian that you're saying, in the end, it's still about the demand. Right? So the demand of the people. I think what you're seeing now in the, what I will say, crypto space or stablecoin space, where we've seen in the past, you have seen market makers wash trades. I mean, that's the reality of probably what has happened. And there are some market makers that do that, and other market makers won't do that because they feel that it would be eventually, if it's not illegal this second, it will be illegal. So follow the right rule game is what 50% of them will do. The other 50% may not. So you may have seen different volumes. So the way I would look at certain stable coins, like if you are Euro, for example, I know from our side, we have, personally, our company side has huge demand for Euro stable coins, right? So, but we haven't seen any with huge volumes out there, but we are very happy to work with them because we see end users that want it. So I think it just still comes down from a demand point of view, and this is not a specific to at all Stellar.
Todd Marakis from JST Capital, guys, market maker. So, all right. Well, thank you everybody for attending.
Thanks, guys.
We're going to have another liquidity session that includes alcohol at 7 o'clock. Please join us.